heading into the Affordable Care Act. Good news for the Affordable Care Act is nothing has really changed from last year. The Affordable Care Act has been around for a number of years. The entire purpose of the Affordable Care Act was to make sure that every American had access to eligible health insurance, irrespective of prior conditions. What we're taking a look at here for the Affordable Care Act and what the applicability is to VITA is really going through the process and understanding a few different components. When we take a look at the Affordable Care Act, it is having a mandate that every eligible person have some type of insurance. What we're going to be asking about in VITA is, did the individual have what we consider minimal essential coverage? And we'll talk a little bit more about that definition. The majority of clients that come into VITA have had minimal essential coverage for the entire year, which makes the Affordable Care Act much easier to deal with, and we'll talk about what that minimal essential coverage is. If they do not have minimal essential coverage, we'll move on to the next step. But if the individual purchased their minimal essential coverage through the marketplace, the healthcare.gov website, they may be eligible for a premium tax credit. And a lot of the individuals that we have that have purchased insurance through the marketplace are eligible because of their income levels for a reduced amount of monthly insurance costs. That's what we call the advanced premium tax credit. So the first two scenarios, either minimal essential coverage or that they purchased insurance through the marketplace, we're basically going to use the information provided by the client to complete the return. We'll talk about the third area, which is essentially what happens if they did not have insurance for the entire year. What are the responsibilities that we have? What's that shared responsibility payment going to look like? And are there any exemptions to that process? Can they be exempted from the shared responsibility payment? We'll talk about those scenarios. So the main thing we're going to take a look at is how do we report health care? How do we take a look at the premium tax credit, exemptions from coverage, and then what would that shared responsibility payment be if we do not have an exemption? So part of your intake form will be asking the taxpayer, did you have health care coverage for yourself, your spouse, and any of your dependents? Typically, what we're going to be looking at here is making sure that everyone we report on the return is going to fall under one of those categories. Either they had minimal essential coverage or they were exempt from the shared responsibility payment. We'll kind of go through a lot of those processes throughout the rest of the evening. So we do need to make sure it's for the taxpayer, for the spouse, and any dependents reported on that return. Sometimes we'll see a situation where you may have dependents on a return and they may be covered by a former spouse's insurance plan. That's entirely acceptable, that's fine. So we'll take a look at some options that you have there. The first thing we're going to start talking about is minimal essential coverage. What does it mean? And minimal essential coverage is a very broad category of insurance. And as long as you've basically had insurance from a variety of sources, first one being an employer-sponsored plan. So if your employer offers health insurance and you participated in that plan, it's generally going to meet the minimal essential coverage requirements. So if a client comes into VITA and says that they've had employer-provided health care for the entire year, we take them at face value and we'll check the box to say you had minimal essential coverage for the entire year. And we're done. Minimal essential coverage can either be employer-provided health care or a COBRA type payment. So if they separated from service and they're continuing by paying a COBRA rate for insurance, which is probably the most expensive insurance you can buy, but does cover as employer-provided coverage. One of the other ones we're going to see would be any individual purchase coverage. You can either go directly to the insurance companies and purchase health care. Most of our VITA clients will get a much greater benefit by purchasing their insurance if they do not have the opportunity for coverage through an employer by going to the marketplace. The marketplace has much more options available to them. They also have the ability to take an advanced premium credit, which we'll be talking about in just a few minutes. The other benefit we have, the third category, will be anyone who's on a specific government-sponsored program. So if you're on Medicare, you have minimal essential coverage. If you're on Medicaid, you have minimal essential coverage. Most children in the Commonwealth of Pennsylvania can register and get CHIP coverage. If you have CHIP coverage, that is minimal essential coverage, and you're exempt from the shared responsibility payment. So a lot of the areas that we take a look at If you have retirees that are on Medicare, they're exempt. Individuals that are on Medicaid or on CHIP are exempt. If you have covered under your employer's plan, you have minimal essential coverage, and you're fine. Again, we're going to take the taxpayer's taxpayer's word. We don't need to actually have them bring in their copies of the insurance binders and everything else. We'll take them on their word of the type of coverage that they have. And I think probably what we've seen, the majority of clients meet the minimal essential coverage exemption. And the returning see a lot of areas where I think in the past most sites have seen somewhere around 80% plus minimal essential coverage, depending on some of the sites, either employer-sponsored Medicare or through the marketplace. So what we're going to focus on is a lot of the areas that we typically see within VITA. So if you do have minimal essential coverage for the entire year, one of the questionnaires that you'll go through right before you finish preparing the return is just asking, did you have minimal essential coverage for the entire year? You check the box, yes. You move on and say, did the following individuals who are part of your return all have minimal essential coverage? You check the box, yes, and we're done. One area that we do want to take a look at is if their minimal essential coverage was purchased through the marketplace. Essentially that they went through and they bought it through healthcare.gov. That question will arise. Did you purchase your insurance through the marketplace? If you answer yes, that's going to take us to another section within TaxSlayer. What will happen is that the client will be getting a Form 1095-A that will generally be issued by January 31st and will hopefully be issued correctly. So what we'll need to do before we can prepare a return, if anyone comes in and says, yes, I purchased healthcare through the marketplace, but no, I don't have my Form 1095-A, we can see if we have the ability for them to pull up their account online and get a copy of the 1095-A, or we have to say, thank you very much, we'll complete as much as we can, but we cannot finish the return without the 1095-A. It's going to be critical that we have that in order to complete the return. That's going to contain a lot of information about what type of program they were on, how much their premium payments were per month, whether or not they've received any what we call advanced premium against their insurance coverage. So once we have the Form 1095-A, we can simply enter that information. And TaxSlayer does a pretty decent job of using the information off the Form 1095-A to complete the required forms. In this case, it would be the Form 8962. Again, you do not need to memorize any of these items. The only thing that we ask that you know is if you have marketplace coverage, check the box, and TaxSlayer will prompt you to enter the information off the Form 1095-A. One of the main reasons we need that is because of this premium tax credit. Most of the clients that come into VITA will qualify for a premium tax credit. So in order to be eligible, they have to meet a couple conditions. First, they have to have purchased their insurance through the marketplace. You cannot get the credit if you bought it through an insurance company directly. If you were offered through your employer, it has to be purchased through the marketplace. They have to have been purchasing insurance because they were not eligible for any other coverage other than marketplace insurance. So if they were offered insurance from their employer and they chose not to take it and they went to the marketplace, they're not eligible for the premium tax credit. One of the other things we take a look at is in order to get the credit, their income has to be at least 100% of the federal poverty level, but not more than 400%. Again, the system's going to calculate this automatically. It's just kind of a situation we take a look at to see what's the federal poverty limit. If you're above it and you're up to 4 times above it, you qualify for the premium credit. If you fall beneath the federal poverty level, you're not eligible for the credit because the government feels that you should be enrolled within their Medicaid program. If you're married, you have to file a joint return with your spouse, unless the taxpayer is considered unmarried for head of household purposes. So if we go through that process where we're considered unmarried because the spouse lived away for at least the last 6 months of the year, and you had a principal place of residence for more than half the year of a qualifying child, then you can be considered head of household. So there's one status you cannot use and claim the premium tax credit: married filing separately. So we thought we were done talking about the detriments of married filing separately when we got through deductions and credits, right? It still comes back to bite us here at Affordable Care Act. You do not get a premium tax credit if you file married filing separately. The other thing we take a look at is you cannot be dependent on someone else's return and take a premium tax credit, so that does not work either. One of the areas we'll see is if the taxpayer did not take the premium credit when they took insurance, the system will automatically calculate it for them. But the main reason why we need that Form 1095-A is most of the individuals coming through VITA, when they purchased their insurance through the marketplace, had applied an advanced premium credit against their monthly insurance cost. When the first initial sign-up had occurred for the marketplace, you could call up or log in and basically tell the operator how much income you thought you would have. It allowed the opportunity for you to say, I have a lot less income, so bump up my advanced premium credit and I will pay a lot less for medical insurance each month. The reason why we need to take a look at the advanced premium credit is because we're going to reconcile the amount of income that you reported to the marketplace to get your credit versus how much income you actually earned for the year. So one of the things we do want to take a look at is making sure that we complete all the information as is presented to us. The Form 1095-A will show the amount of advanced premium credit. Now hopefully we're going to see a lot less discrepancies, because what has happened with the marketplace now is now they're pulling information from the prior year return. And so you have to tell the marketplace why you would have had any substantial changes. So hopefully we're going to see less discrepancies of changes in income. But I do want to caution some of the areas we do see that people have reduced refunds or maybe some payments owed is because there is a change from what they have reported to the marketplace versus what their income ends up being for the 2017 year. If we do have that issue, you can always inform the client if they do have marketplace-based insurance. They can call or contact the marketplace at any time and update their income. That will change their advanced premium credit so they do not get hit at the end of the year. Now, the one condition that we do have, if they received an advanced premium credit, they have to file a federal income tax return. So if we think all the way back to our first session when we talked about taxes, when we talked about who must file was generally based on filing status and the amount of income. One area, it does not matter, your filing status or your income, is if you received an advanced premium credit, you must file an income tax return. They will get notices from the IRS if they have not filed a return. That usually happens much later than the April 15th time period. But if they received an advanced premium credit, they must file an income tax return. Again, they're generally going to be getting that Form 1095-A by January 31st. And as we mentioned, hopefully it's correct the first time. And if they correct it, hopefully they didn't correct it incorrectly. And we need a third form. Hopefully the IRS is getting better at that. Unfortunately, what happens is the government will find the lowest paid contractor to handle their reporting mechanisms. So we don't always get the best quality the first time, but hopefully we're getting better at it. If for some reason the Form 1095-A has not arrived or the taxpayer said, I did not get one, they can go back and log into their marketplace account. They can call the marketplace customer service number and request a new one. If you get one and it looks completely incorrect, you can have them contact and make sure all the information is what they believe to be true. So a couple things we take a look at there. If we have the Form 1095-A, it's going to report how much they have in advanced premium credit. Again, all we have to do is enter that information directly in a tax layer, and it'll calculate that for us. Yes?
Question. You said that the only way they can move the marketplace is they couldn't get insurance like that. Where does COBRA fit into that? In other words, must I get COBRA?
Well, right. So the question kind of relates to what happens with going to the marketplace, when can I get coverage? The issue that we take a look at is mainly for the premium tax credit. You can go in the marketplace and get coverage. Typically, COBRA is going to be a very expensive option for people for health care coverage. So what we take a look at is you could go to the marketplace, and because COBRA is an option, you'd actually be able to purchase through the marketplace and get coverage there. So you're not required to take COBRA coverage. You can go to the marketplace and take it through that option. Okay, so really once we enter all that information, what will happen is TaxSlayer will go through all the calculations, the iterations. You do not have to memorize any of these charts, any of the calculations. We'll see how long the Affordable Care Act stays in the condition it's in now. We do have it for the 2017 filing season, so we are going to go ahead and use that information as it comes through. Again, where we're going to see a lot of these areas are when an individual has gone through the marketplace for insurance. We're simply going to enter the information off that 1095-A. The system's going to calculate on the 8962 the amount of any additional credit that they're entitled to, or if for some reason the income has changed from the time that they had signed up for Marketplace Insurance, and they may end up owing a little bit of that money back. Hopefully with our taxpayers, because of their income level, that there are some caps on the amount of repayment that they would have to pay back to the Marketplace. There are a couple unique areas. If there are some newly married taxpayers, we see those on occasion. If you do run into a complex issue on Affordable Care Act, by all means, ask for help. So what happens usually with Affordable Care Act is these things usually take no time at all. They're fairly easy to walk through. They do not add much more time to the preparation of the return, or these things are so convoluted that it's going to take us a lot of time to kind of figure out what's going on. So if you do have those issues, it's no problem to say, we have some complexities here, we need to take a look. Perhaps we need to review that with your site coordinator. Perhaps it's going to come up to Ezra or Steve. Perhaps I get involved. And then hopefully between all of us, we'll come up with something that sounds good and works and can have a solution for the client. So if you do run into any issues, by all means, take your time, ask questions, and we'll go through the process. So those are our general two areas. They have minimal essential coverage, or they also purchase that through the healthcare.gov, and we have to take a look and see if they have any premium credit or any repayment. The one issue we need to take a look at here is the individual shared responsibility. And we do have information within your tab H of your 4012. The individual shared responsibility starts on H22. And what we're looking at here is every taxpayer within the U.S. and their dependents are required to have one of the following three areas. Either they have minimal essential coverage, they qualify for an exemption for minimal essential coverage, or they have to make a shared responsibility payment when they're filing their 2017 1040. The interesting part about what a definition of each month is we only need health care coverage for 1 day out of that month. So any partial coverage counts as a full month. So they're treated as having minimal essential coverage for any part of the month that they are covered. What that allows for is for changes in employment. So if you leave employment on the 30th of a month, you're considered having coverage for that entire period of time. If you start a job with a new employer and they have a waiting period before you can become part of the healthcare program, if you sign up on the 17th of the month, you're considered covered for that entire month. So you don't have to worry about shared responsibility for any partial month. It's only for any full month that you do not have coverage or an exemption. Parents are responsible for making sure that their dependent children have coverage. So typically that's going to be with the person who is filing the return. So if you're claiming a dependent on the return, you're responsible for ensuring that they either have minimal essential coverage, an exemption, or you'll be making the shared responsibility on their behalf. What we take a look at is what does that shared responsibility payment look like? So if the taxpayer, their spouse, or their dependents do not have minimal essential coverage and they do not qualify for an exemption, then the system is automatically going to calculate a shared responsibility payment. What the problem that we have with the shared responsibility payment is actually a number that's the greater of. In most cases, what we've talked about with taxes is the lesser of a number. The lesser of a deduction amount with an educator expense, it's the lesser of $250 or whatever you paid. With the child and dependent care credits, the lesser of $3,000 per dependent or the amount you actually paid. With the shared responsibility, it's the greater of. Either the greater of 2.5% of your total household income or an amount per individual. $695 per child or $695 per adult or just under $350 per child, the greater of. Now there is a family maximum. There are some phase outs that we have in. Most of our individuals within VITA hopefully are not hitting substantial shared responsibility payment, but it can be quite onerous for people outside of the VITA program. There are some additional caps which will be calculated by the system, so we don't actually have to go through any detailed calculations. The only thing that we do if someone comes in and says, I do not have minimal essential coverage, is we'll walk through the exemptions. What would be the possibility that they can be exempted from having coverage? And if we don't have a valid exemption, then they're going to be subject to the shared responsibility payment. Now, when we talk about exemptions, there are a couple different ones that we're going to be taking a look at. These are actually a little bit further ahead in your 4012. They're on H11. But the main ones we're going to see are any marketplace granted exemptions, and we're going to be talking about those in just a little bit. So the marketplace exemption means that an individual has the ability to contact the marketplace and explain why they're not required to have coverage. And there are a couple reasons, and we'll take a look at that in the next slide, as to what the marketplace will grant as exemptions. The second exemption would be an income below the filing threshold. So again, what we're taking a look at is, do they need to file an income tax return? That's going to be automatically calculated by TaxSlayer. If they fall beneath the filing threshold, it will automatically check the box for the Part 2 exemption, and they do not have a shared responsibility payment. There is a third category, which are family coverage exemptions, which we're going to take a look at in just a minute here. So that's the list at the bottom of the slide here. The most common ones that we'll see are traditionally coverage considered unaffordable, which we'll spend a little bit more time talking about. Also the short coverage gap, a less than 3-month period, which we'll be talking about as well. The other ones that could qualify, if you're a citizen living abroad, it has to be for at least 330 days, so the majority of the year is outside the country. You're a member of a health care sharing ministry, which is becoming more and more popular in our area, particularly for self-employed individuals. If you're incarcerated, obviously you do not have choice in health care. You have what the government will provide for you, so you're not required to go out and get your own health care. If you were born, adopted, or died, after you die, you are no longer responsible for health care. After you die, you no longer care that you're not responsible for health care. The nice part is TaxSlayer will go ahead and automatically fill in the code H's. So they know the time that you were alive, they know the time that you were not alive. Technically not you, your client was not alive, or your client was not yet born. So we don't need to worry about filling those in. Those will be done automatically. We do get oftentimes questions about certain religious sects here in Lancaster County. Amish, certain Mennonite, certain Brethren religions can be exempted from medical coverage. The interesting part, that's actually granted by the marketplace. So one of the exemptions that we have is if you are a member of an order that does not believe in providing health insurance coverage. If you happen to be Old Order Amish, you can simply log in on your home personal computer to the marketplace and request an exemption for coverage. Yes?
See, when we were at line, member of health care sharing ministry, I kind of jumped ahead. Oh, that means Amish. So it's not.
That's
so.
Right.
What is a healthcare
Sure.
sharing ministry? Would the person? I mean, they wouldn't know.
Right. Yeah. So.
Give me an example.
Sure. So what a health sharing ministry is basically it's an affiliation with a religious organization that is almost like a self-insured plan. So what you do is you find a collective of people who gather together, and they basically have an assessment to say on a monthly basis you will contribute the following amounts. And what will happen is if you have medical bills, and you would submit your medical coverage to the organization, and they will go ahead and decide if they're going to pay or not pay the medical bills. So it's basically a collection of people. They have had an exemption from healthcare coverage itself because they're members of a health sharing ministry. They will generally get, again, we will ask if there's an exemption. They will know if they're part of one. It's not something you kind of back into. You kind of have to.
Take their word.
We take their word for it. They may have, in some cases, they may actually bring a form in from the health sharing ministry to say, here's how much you contributed for the year. And they may try and take a look at that as a deduction. The problem is that because it's not insurance, it's not a charitable contribution, it's not a deduction. Because it's not directly related to a medical cost, so it's not a Schedule A itemized medical expense. It's not a charitable contribution because you're getting some benefit out of it, so we really don't get to take a deduction for those costs for medical health sharing programs. But the Amish, and ironically, we have had Amish that have come in. I do not ask how they were able to contact the marketplace. The bishop's not going to ask how they contacted the marketplace, whether they got on their smartphone, whether they went to the Affordability library to use the computer system there. But it is kind of unique that the government will make an organization that does not believe in technology to go ahead and contact them to say why they're exempt and give them a digitized number to put on their return when they file. And particularly, it's a shame you do that for people that usually have multiple dependents. So it's not just one we need to worry about. Usually it's 8 to 12 numbers coming in for them and their entire family. But most of the Amish know how to get their exemption numbers. It's not quite of a shock. They're all well versed in that process. So if you do have an Amish family that comes in, they will probably bring their pre-printed forms with their numbers. So that's one of the options you have when you go to the marketplace for an exemption. So you can call, you can log in, go to your account. There are a couple other areas that you can also get an exemption for coverage. You may apply for a hardship exemption even during the filing season. So if you want to go back and say, I didn't have coverage, it might be an opportunity to point out to a client you may qualify for a hardship exemption. And kind of these have a little bit more detail listed on H14 of your 4012, but the most common ones we're going to see relate to housing situations. So if a person was homeless, if they were evicted in the last 6 months or facing an eviction procedure, if their utilities were shut off, if they were a victim of domestic violence, if they were appealing their medical decision and they have not been successful yet, but they're still in appeals, they can be exempt. If there was a disaster that resulted in significant property damage, so if you have anyone who may have moved from a federal disaster area up here to Lancaster County, they may be exempt for health care for that period of time. If they've declared bankruptcy, if they've had significant debt for medical expenses, if they've had high expenses for caring for a disabled or aging relative, if for some reason that they had a order from an ex-spouse that the ex-spouse was supposed to cover children and the ex-spouse did not, that would be a marketplace granted exemption. They had a recent death of a close family member. If they were under the Medicare eligibility and the state did not expand Medicaid eligibility, they could get an exemption. If they had an individual health plan that was canceled and the marketplace is unaffordable, and a whole host of other reasons. There's other hardships and everything else that they can apply for. Now, the nice part is they can actually do this at any point in time. So even if we're filing return for the 2017 year, and they say, I didn't have health care coverage, they can still go back to the marketplace and request retroactive relief for the period of time. So they can go back and request it. If they made a request, we can put the code in as pending and just wait for that to come through. Question?
Are they going to get an exemption for the year or for a certain number of months?
When they get an exemption from the marketplace, it'll be for that period of time. So they'll basically state the case to the marketplace of why they would be granted an exemption. If it's for a period of time like homelessness or natural disaster, it will be for that period of time, not necessarily for the entire year. But they can contact the marketplace. There's a whole opportunity for them to claim an exemption that aren't even listed in here for hardship. So the marketplace will grant those, and it can be done even after the fact. So if someone comes in and says, I did not have health insurance, I had to take care of my spouse who had just undue medical bills, we can say, well, you may be eligible for an exemption from the marketplace. You can contact the marketplace and see if they will grant you an exemption. And if they can get a number before we file the return, we can simply put the number in. If they don't get it in time, we can file it with pending in the exemption number. Okay. Questions on the marketplace granted exemptions? Usually, hopefully, the clients will know to go on if they're part of the marketplace itself, if they're getting coverage from there. We highly encourage them to let the marketplace know if there are changes, particularly in income or employment, because those can greatly impact the ability for the tax credit, that advanced premium credit, or if they run into any of these situations that were up here on the board, hopefully they can go ahead and get an exemption for coverage. Now we'll talk about two areas that we will see a little bit more frequently here within VITA. If we have an exemption that we can help put on the return. This one's kind of a unique one. Is coverage considered unaffordable? And this has not changed at all from last year. So if you were a volunteer last year and you used the coverage unaffordable exemption, it's going to be the exact same process this year. The numbers, in fact, haven't changed. What the coverage unaffordable comes up with is if the cost of health care, after we take into account the advanced premium credits and everything else, would be higher than 8.16% of your household income, you do not need to have coverage. It's going to be an exemption from the shared responsibility payment. The most common one we run into is that you are offered health care coverage from your employer, but your co-payment or your cost of employee-based health care is too high. It's more than your income can bear, especially if you're offered family coverage. If that happens, what we generally will get is a form from the employer, generally it's the form 1095C, which will list out how much the cost of employee-based coverage would be. If they're trying to get an exemption based on family coverage, we generally will need a opportunity to kind of calculate that from what the cost of family coverage would have been. So if the employee brings that in, that's great. If not, we may need to contact Human Resources to help calculate that amount for them. This is one area where we probably need more information rather than just the word of the taxpayer to say coverage is unaffordable. So we can go through some calculations here. If there's no offer of coverage through an employer, then we can take a look at the marketplace affordability. And we actually have a guide in here for you to go through that process. Essentially what we're going to do is use kind of a chart to determine what their modified gross income is. This will be something based off of our tax system. You can actually take a look and see what their modified gross income looks like. And then what we'll do is take a look at their household size and determine whether or not coverage is considered unaffordable. So if you have questions with this, generally what we've gotten to at this point in the return is the taxpayer did not have coverage. They did not have the ability to request a marketplace exemption, nor would they qualify for a marketplace exemption. So we'll need to do some additional calculation to see whether or not coverage is considered unaffordable. So we are going to have some additional videos and training on the Affordable Care Act, particularly on the coverage unaffordable. So we just want to mention in our training today that there is an option out there. So if they come to you and say, you know, I know I was supposed to have insurance, I've known for a couple of years I'm supposed to have insurance, I just didn't get it yet. Do we have any exemptions from the penalty? Well, we may be able to take this coverage unaffordable, but there are some things we'll need to do to walk through it. So if you do run into that, we are going to have some additional training on the process of how you go through it. Certainly if you run in that situation, grab your site coordinator as well, because we may take some additional time with that return. Okay, any questions so far on the coverage unaffordable? For the returning volunteers, have you used that a bit in the past? Okay, a couple sites have used it, not all the sites have, so it's kind of a case-by-case basis. One exemption we may see a little bit more of is what we call the short coverage gap exemption. So what we're looking at here is the short coverage gap exemption is designed for a period of less than 3 months. So when we take a look at the entire year, you had to have had coverage gap for less than a 3-month period. Once you hit 3 full months, you no longer qualify for the short-term coverage gap. It has to be a period of less than 3 months. So we can take a look. Usually this might be because you're in between insurance plans. Maybe you have left a job and you're still in the process of looking for new employment. Maybe if you are signing up for some other type of plan and you haven't been enrolled right away, this allows you the opportunity of not being penalized for being in between coverage. But it has to be within a reasonable amount of time. Yes?
Is 3 months basically like 90 days, or like if I have a week in March and then all of April and a week in May?
Right. So what we're looking at, it has to be full months. So if you have a partial month, so if you lost coverage in March and you're covered all the way through March 20th, you don't have coverage for April, but you enroll by May 20th, you only have 1 month of gap. So it's only that 1 month period. So that would be our month without coverage. So what we take a look at is less than 3 months. So you can have 2 full months plus a partial month to qualify. So what we take a look at here is we have to go through and identify which months would be considered uninsured. And if we had some other exemption, and kind of the point to be, if a marketplace grants an exemption, they don't grant it for the entire year, we can piggyback these. So if they granted an exemption for 10 months, we can use the short-term coverage gap for the other 2 potentially. Yes?
Give me a question. Do they have to be consecutive months to cover it, or can they be scattered?
They can be scattered as long as they do not exceed 3 full months. So once we hit 3 months, then the coverage gap doesn't exist, and then you'll be subject to the shared responsibility for that period of time. So as long as it's less than 3 months, we're generally fine. So we can use other exemptions if you're incarcerated and someone comes out of incarceration and they haven't been able to get insurance yet, we can use that short-term coverage gap. One of the other things we do just want to point out is we have a look-back provision, meaning that if a taxpayer has coverage gap, and what we'd be looking at here predominantly for the 2017 year is if they say, I did not have insurance coverage for January or February, we can't just assume that they qualify for the short-term coverage gap. We have to look to the prior year. So if they did not have coverage at the end of 2016 and the beginning of 2017, that period of time cannot exceed the 3 months. So it can't be 3 months or more. So if someone says, I did not have coverage at the beginning of the year, then we need to just go back and double check to see, did they try and take the short-term exemption for the prior year? So that cannot exceed 3 months. We don't have a look forward. So if someone comes in and says, I do not have insurance for November or December of 2017, we can take the short-term coverage gap. If they come in very early, in January, and they say, I still don't have insurance yet, what you probably want to tell them is try and get insurance by January 31st. Because if you get it for at least that one day in January, then you can still meet the short-term coverage gap, and then you'll be fine. So if you can find out how to get on insurance for at least the end of January, then you don't have to worry about being ineligible for the 2018 year. So those are just some of the main areas we see. Generally, you'll get a marketplace granted exemption. If they do not qualify, the two that we typically will take a look at is whether coverage is considered unaffordable or there might be a short-term coverage gap in place. Okay, any questions with the Affordable Care Act? We're trying not to scare anybody of the Affordable Care Act. In most cases, for the sites, again, we're going to have minimal essential coverage. A lot of our clients come in and they're covered by Medicare, they're covered by CHIP, they're covered by Medicaid, or they have employer-based coverage, so we don't really have much of an issue, or they have coverage for the marketplace. Yes, sir.
I think there's talking about people who are incarcerated that before they leave incarceration, that the prison is working with the state to get them through the enrollment process for Medicaid, so that there's not a gap.
That's correct. So basically, if they're enrolled in Medicaid, then they're going to be fine. It's going to be considered minimal essential coverage. For the time that they're incarcerated, they're exempt. They actually have prison-based insurance, so they don't have the freedom and flexibility.
When they get out, because they're working on that process.
Correct. Yep, exactly. So for anyone who's coming out of incarceration, the state is working with them to make sure that they're getting back into the employment world and having coverage. Yep. Okay. Great. So again, we'll have additional training on ACA, particularly on the coverage unaffordable. But again, don't want to scare anyone away. So we don't want to get to this part of the training and you realize that there are some unique issues. For most of the areas, again, it's a very simple process. We check a couple boxes and the return's ready to go. If there are some unique issues, again, we'll have plenty of people to help you out with that process, and we'll put our best efforts forward to make sure the clients are getting the best care possible. So with that, I think we have a couple more announcements from Ezra, and do want to mention, if you do want to stick around later to work on the returns by hand, we'd be happy to help you walk through that process. If not, we can always do that in January too. All right, so we'll turn it back over to Ezra.